Welcome to Uncommon Capital Quick Takes. Short episodes, smart insights, real-world investing explained simply. In just a few minutes, we'll break down one topic shaping private markets and the economy today. Semi-liquid investment vehicles have been getting a lot more attention lately, and for good reason. They've opened the door for more individual investors and wealth management clients to access private markets. Things like private credit, real estate, infrastructure, and other alternative income-oriented strategies that were historically dominated by large institutions. But they've also drawn criticism, especially around one issue: liquidity. And that's really the key to understanding these vehicles. They are not traditional private drawdown funds with long lockups and capital calls, but they're also not mutual funds or ETFs that offer daily liquidity. They're a bridge between private markets and traditional wealth portfolios. For decades, private markets were largely the domain of pensions, endowments, insurance companies, and other institutional investors. That made sense because private assets are not naturally liquid. A private loan, a commercial building, or an infrastructure project cannot be sold instantly the way a publicly traded stock can. Traditional private funds were built around that reality. But those structures can be cumbersome for individual investors. Capital calls, lockups, and operational complexity are often difficult to incorporate into a wealth portfolio, and many investors fail to meet the minimum requirements to invest in these types of structures. So over the last several years, the market has developed structures designed to make private investing more accessible. That includes things like interval funds, business development companies, also known as BDCs, tender offer funds, and non-traded REITs, and other semi-liquid structures. These vehicles often allow investors to subscribe regularly and offer periodic opportunities to redeem. And that's where investors need to pay attention, because semi-liquid does not mean fully liquid. Many of these vehicles offer quarterly liquidity, often with limits, commonly around 5% of the fund's assets per quarter. And that number matters. A 5% quarterly redemption limit does not mean every investor is guaranteed to get all of their money back every quarter. It usually means that the fund as a whole will only repurchase up to 5% of its assets during the redemption window. If a redemption request exceeds that amount, investors may receive only part of their requested withdrawal, with the remainder carried forward. That is not necessarily a flaw. It reflects the fact that the underlying assets themselves are not fully liquid. If a manager owns private loans, real estate, or infrastructure assets, they cannot instantly liquidate a large portion of the portfolio without potentially harming remaining investors. So the redemption limits are designed to balance investor access with portfolio stability. And that leads to the most important idea here. Semi-liquid vehicles provide liquidity features. They do not provide guaranteed liquidity. Investors have seen this play out in practice. Over the past several years, some large semi-liquid private market vehicles have received redemption requests that exceed their stated limits. In those cases, investors were not able to redeem everything they requested immediately because the funds were operating according to their established liquidity terms. Those situations generated headlines, but they also highlighted an important point. The redemption limits were not a surprise. They were part of the structure from the beginning. The lesson is not that the vehicles failed. The lesson is that investors need to understand the liquidity provisions before they invest. And that doesn't make these vehicles bad. In many cases, they can be extremely useful. They can broaden access to private markets, simplify portfolio construction, and make it easier for advisors to allocate to alternative asset classes. But investors need to use them appropriately. These are generally long-term investments. They're not cash alternatives, they're not trading vehicles, and they should not be treated like public market ETFs. The underlying assets still matter. Private credit is still private credit, so the wrapper may be more flexible, but it does not change the nature of the assets inside. So the right way to think about semi-liquid vehicles is not as liquid private markets. It's private market exposure with a more flexible wrapper. And the key question for investors is simple. Does the liquidity structure of the vehicle match the investor's time horizon and expectations? Because in private markets, structure matters. And with semi-liquid vehicles, understanding the structure may be just as important as understanding the investment itself. I'm Brian Resnick, and this has been an Uncommon Capital Quick Take.